quick note: this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Most traders are obsessed with entries. They spend the majority of their time trying to perfect the exact point at which they enter a trade, believing that precision at entry is what determines profitability. This belief is not only flawed, it is one of the primary reasons traders fail to achieve consistency. The reality is that entry is a small component of a much larger process, and overemphasizing it leads to distorted decision making. When you look at how professional traders operate, the focus is not on pinpointing the exact top or bottom. Instead, the focus is on structuring trades in a way that aligns with probabilistic outcomes and risk control. Entry becomes a tool within a broader framework, not the defining factor of success. The reason entry is overvalued is psychological. It provides a sense of control. If you believe that finding the perfect entry leads to profit, you can convince yourself that success is simply a matter of analysis. But markets do not reward precision in isolation. They reward discipline, risk management, and the ability to manage uncertainty over time. In institutional environments, entry is often deliberately imprecise. Traders scale into positions, accept that initial entries may not be optimal, and focus instead on how the position evolves. This is fundamentally different from the retail mindset, which treats each trade as a binary event, either right or wrong. The key shift here is understanding that entry does not define the trade. Structure defines the trade: how you size the position, where you define risk, how you manage the position once it moves, and how it fits within your overall portfolio. These are the elements that determine long-term performance. When you detach from the need for perfect entries, your decision-making becomes more stable. You stop reacting emotionally to small price movements, and you start thinking in terms of scenarios rather than exact outcomes. This is where professional execution begins. And to understand why entry matters less than you think, you need to look at trading through the lens of distribution rather than individual outcomes. Every trade you take is part of a larger series. Within that series, individual entries become statistically insignificant compared to the overall process. Imagine two traders with identical strategies and identical risk management. One consistently enters slightly early, the other slightly late. Over a small sample, their results may differ, but over a large sample, those differences converge. What matters is not the exact entry, but the consistency of execution across many trades. This is where most traders go wrong. They evaluate their performance based on individual trades. If a trade loses, they assume the entry was wrong. If a trade wins, they assume the entry was correct. This creates a feedback loop that reinforces the illusion that entry precision is the key variable. In reality, a good trade can lose and a poor trade can win. Entry does not determine outcome, probability does, and probability only reveals itself over a sufficiently large number of observations. Professional traders understand this. They are not trying to win every trade. They are trying to execute their edge consistently. Entry is simply the point at which they begin expressing that edge in the market. This perspective changes everything. Instead of obsessing over whether your entry is perfect, you begin to ask more meaningful questions. Is the trade aligned with your framework? Is the risk defined clearly? Does the potential reward justify the risk? Is the position size appropriate, given current volatility? These are the questions that drive performance. Entry becomes secondary. It is still important, but it is no longer the focal point. It is integrated into a process rather than isolated as a goal. Once you internalize this, your behavior changes. You stop chasing trades. You stop hesitating because the price moves slightly. You stop over-analyzing minor fluctuations. You begin to operate with clarity and structure. Execution at a professional level is about building positions, not placing trades. This distinction is subtle but critical. Retail traders tend to think in terms of single entries and exits. Professionals think in terms of position development over time. When institutions take a view on the market, they rarely commit their full risk at a single price. They scale in, they use liquidity conditions to their advantage, they adjust their exposure as the market evolves. This allows them to manage uncertainty more effectively. Scaling into a position serves multiple purposes. It reduces the impact of timing error, it allows for better average pricing, and it provides flexibility in managing risk. If the market moves against the initial entry, additional entries can improve the overall position, provided the underlying thesis remains valid. This approach requires a different mindset. You must be comfortable with the idea that your first entry may not be optimal. You must be willing to adapt as new information emerges, and you must maintain discipline in how you allocate risk across the position. One of the biggest mistakes traders make is committing full size at the initial entry. This creates pressure. Every tick against the position feels significant because the entire risk is already deployed. This leads to emotional decision making and premature exits. By contrast, scaling allows you to remain composed. You have room to maneuver. You can respond to price action without being forced into reactive decisions. This is a structural advantage that professionals rely on. Execution, therefore, is not about getting in at the perfect price. It is about constructing a position in a way that maximizes your edge while minimizing your exposure to uncertainty. Entry is just the starting point. Another reason entry is overvalued is that traders underestimate the importance of trade management. What you do after you enter a trade has a far greater impact on your results than the entry itself. Consider two traders who enter at the same price. One manages risk effectively, cuts losses quickly, and allows winners to run. The other hesitates, holds on to losing positions, and takes profits too early. Despite identical entries, their outcomes will be dramatically different. This highlights a fundamental truth. Entry does not control the life cycle of a trade. Management does. The decisions you make after entry determine whether a trade contributes positively or negatively to your overall performance. Professional traders spend far more time thinking about management than entry. They define their exit conditions before entering the trade. They know where they are wrong. They know how they will respond to different scenarios. This preparation allows them to act decisively. Retail traders, on the other hand, often enter without a clear plan. They rely on intuition once the trade is live. This leads to inconsistency and emotional volatility. Without predefined rules, every decision becomes reactive. The key here is to shift your focus. Instead of asking where should I enter, ask how will I manage this trade once I am in it. This question forces you to think structurally. It forces you to consider risk, reward, and process. When you prioritize management, entry naturally becomes less critical. You can afford to be slightly early or slightly late because your management framework will compensate for those imperfections. This is how professionals maintain consistency. Liquidity plays a crucial role in execution, and it further reinforces why entry precision is less important than traders believe. Markets are not static. They are dynamic systems driven by flows, orders, and incentives. Price is simply the result of these interactions. When you enter a trade, you are interacting with liquidity. If liquidity is thin, your execution may be poor regardless of how accurate your analysis is. If liquidity is deep, You may achieve better execution even with a less precise entry. Professional traders understand this. They pay close attention to where liquidity is concentrated. They avoid entering during conditions where slippage is likely. They use periods of high liquidity to build positions more efficiently. This is why timing in terms of market conditions matters more than timing in terms of price levels. Entering during a highly liquid session can be more advantageous than trying to catch an exact level in a thin market. Retail traders often ignore this. They focus on charts and indicators without considering the underlying market structure. This leads to poor execution even if their directional view is correct. Understanding liquidity changes how you approach execution. You begin to think in terms of participation rather than prediction. You are not trying to outsmart the market. You are trying to engage with it under favorable conditions. This perspective reduces the importance of entry precision. You accept that execution is influenced by factors beyond your control. Instead of fighting that reality, you adapt to it. This is a hallmark of professional thinking. Slippage is another factor that undermines the importance of precise entries. No matter how accurate your analysis is, the price you intend to enter is not always the price you receive. This is especially true in fast-moving or volatile markets. Slippage introduces variability into your execution. It means that even if you identify the perfect entry point, your actual fill may differ. This makes the pursuit of perfect entries even more futile. Professional traders account for slippage in their planning. They build it into their risk calculations. They understand that execution is not exact, and they design their strategies accordingly. Retail traders, however, often ignore slippage. They assume that their entry price will be executed precisely. When reality differs, it creates frustration and confusion. They may blame their analysis, when in fact the issue lies in execution mechanics. By accepting that slippage is part of trading, you further detach from the need for precision. You focus on robustness instead. Your strategy must work even when execution is imperfect. This is the standard you should aim for. Robust strategies do not rely on exact entries. They rely on favorable risk-reward dynamics and consistent execution. They are resilient to the inevitable imperfections of the market. This is a critical shift. You stop trying to control every variable, and you start designing processes that perform despite uncertainty. Entry becomes one variable among many, not the defining factor. The concept of timing is often misunderstood in trading. Traders equate timing with entry precision, but these are not the same thing. Timing in a professional sense refers to aligning your trades with broader market conditions and regimes. You can have a perfect entry in the wrong environment and still lose money. Conversely, you can have an average entry in the right environment and generate strong returns. This is because market conditions determine the probability of your trade working. Professional traders prioritize timing in terms of context. They ask whether the market is trending or ranging, whether volatility is expanding or contracting, whether risk sentiment is supportive or restrictive. These factors influence the effectiveness of any strategy. Entry precision, by contrast, operates at a micro level. It focuses on exact price points without considering the broader context. This is why it is less important. It addresses a small part of the problem while ignoring the larger picture. When you shift your focus to contextual timing, your approach changes. You become more selective. You trade less frequently, but with higher conviction. You align your positions with prevailing conditions rather than forcing trades. This reduces the need for perfect entries. If your trade is aligned with the dominant market forces, minor variations in entry price become less significant. The broader move compensates for those differences. This is how professionals think. They do not try to control every tick. They position themselves within the flow of the market and allow that flow to work in their favor. Another critical aspect of execution is understanding that price is not the only dimension of a trade. Time is equally important. Trades do not just move in price, they evolve over time. Retail traders often ignore this. They expect immediate results. If a trade does not move in their favor quickly, they assume something is wrong. This leads to premature exits and inconsistent performance. Professional traders, on the other hand, incorporate time into their execution framework. They understand that different setups require different time horizons. Some trades develop quickly, others take time to unfold. This perspective reduces the pressure on entry. If you are expecting a move to develop over days or weeks, the exact entry price becomes less critical. What matters is whether the trade aligns with your thesis and whether your risk is managed appropriately. Time also interacts with volatility. In low volatility environments, price may move slowly, requiring patience. In high volatility environments, moves may occur rapidly, requiring quicker decision making. Understanding this dynamic is essential for effective execution. When you incorporate time into your thinking, you become more flexible. You stop expecting immediate validation. You allow trades to develop according to their natural rhythm. This improves both your decision making and your emotional stability. Entry once again becomes secondary. It is simply the point at which you begin participating in a process that unfolds over time. Execution quality is ultimately about consistency. It is not about isolated moments of precision. It is about repeating a process reliably over time. This is where most traders struggle. Inconsistent execution leads to inconsistent results, regardless of how good your strategy is. If you vary your position size, hesitate on entries, deviate from your rules, or react emotionally, your performance will suffer. Professional traders standardize their execution. They define clear rules for entry, sizing, and management. They follow these rules with discipline. This creates a stable foundation for performance. Entry precision does not contribute to this stability. In fact, it often undermines it. When traders chase perfect entries, they become inconsistent, they hesitate, they overthink, and they miss opportunities. By contrast, a structured approach to execution removes ambiguity. You know what you are looking for, and you act when the conditions are met. This reduces cognitive load and improves decision quality. Consistency also allows you to evaluate your performance objectively. If your process is stable, you can identify what works and what does not. If your process is inconsistent, it becomes impossible to draw meaningful conclusions. This is why execution must be systematized. It must be repeatable. Entry is part of that system, but it is not the focus. The focus is on the integrity of the process as a whole. The final piece of this puzzle is psychological. The obsession with entry is often driven by the desire to avoid losses. Traders believe that if they can find the perfect entry, they can eliminate risk. This is an illusion. Losses are an inherent part of trading. No entry, no matter how precise, can eliminate them. What matters is how you manage those losses and how they fit within your overall strategy. When you accept this, your relationship with entry changes. You no longer see it as a way to avoid losing, you see it as a way to initiate a probabilistic process. This removes a significant amount of pressure. This psychological shift is critical. It allows you to execute without fear. You are no longer trying to be perfect. You are trying to be consistent. This leads to better decisions and more stable performance. Professional traders operate with this mindset. They accept uncertainty, they accept imperfection, they focus on what they can control and ignore what they cannot. Entry is not something you can perfect, it is something you integrate into a broader framework. Once you understand this, your approach to trading becomes more sophisticated, more disciplined, and ultimately more effective. This is the reality of execution. It is not about being right at the exact moment. It is about building a process that works over time. Once you begin to move away from entry obsession, the next layer of understanding is how execution integrates with risk asymmetry. Every trade you take should be structured so that the potential upside meaningfully outweighs the downside. This is not achieved through perfect entry, it is achieved through how the trade is constructed. A trader who enters at an average price but structures a trade with a 2-to-1 or 3-to-1 reward relative to risk will outperform a trader who enters perfectly but manages the trade poorly. This is because over time asymmetry compounds. Small controlled losses combined with larger controlled gains create a positive expectancy. The mistake most traders make is trying to engineer asymmetry through entry precision. They attempt to enter at exact turning points to maximize reward and minimize risk. The problem is that this approach is unreliable. Markets do not consistently provide perfect turning points, and attempting to capture them leads to missed opportunities and inconsistent behavior. Professional traders approach asymmetry differently. They define risk clearly, often through invalidation levels, and then allow the trade to express its potential within that framework. Entry is chosen to support that structure, not to define it. This is a crucial distinction. You are not entering because the price is perfect. You are entering because the structure allows for favorable asymmetry. If the structure is sound, slight variations in entry become less important. This also influences how you manage trades. When you understand that asymmetry is the goal, you become more patient with winners and more decisive with losers. You allow the distribution of outcomes to work in your favor rather than trying to force precision at the outset. Execution, therefore, is about aligning entry with structure, not replacing structure with entry. Another key component of execution is understanding the role of confirmation. Many traders wait for confirmation before entering a trade, believing it increases the probability of success. While confirmation has value, it comes at a cost, and that cost is often misunderstood. Confirmation typically means entering at a worse price. By waiting for additional signals, you are effectively sacrificing entry precision in exchange for increased confidence. This is not inherently wrong, but it must be understood within the context of your overall strategy. Professional traders evaluate this trade-off explicitly. They understand that earlier entries may offer better risk-reward but lower confirmation, while later entries offer higher confirmation but reduced asymmetry. Neither is inherently superior. The key is consistency. The mistake is to switch between these approaches based on recent outcomes. If a trader takes early entries and experiences losses, they may shift to waiting for confirmation. If they then miss moves, they revert back to early entries. This inconsistency destroys edge. Execution requires a defined approach. You must decide how you balance confirmation and price. Once that decision is made, you must apply it consistently across trades. This allows your edge to play out over time. Entry in this context is simply the point at which your criteria are met. It is not about perfection. It is about alignment with your defined process. This is how professionals remove ambiguity. They are not constantly adjusting their entry approach based on emotion. They follow a structured framework that integrates confirmation, risk, and timing. Market impact is another factor that highlights the limited importance of entry precision, particularly at scale. While retail traders may not move the market significantly, understanding this concept is essential for thinking like a professional. Large participants cannot enter positions at a single price without affecting the market. Their size forces them to distribute their orders over time. This means their execution is inherently imperfect in terms of entry precision, yet they still achieve consistent profitability. The reason is that their edge does not rely on precise entries. It relies on information, positioning, and structure. They are focused on the broader move, not the exact price at which they initiate the trade. This perspective is valuable even for smaller traders. It reinforces the idea that perfection at entry is not required for success. What matters is how you engage with the market over time. Thinking in terms of market impact also changes how you view price movements. You begin to see them as the result of flows rather than signals. This reduces the temptation to react to every minor fluctuation. Execution becomes about participation within those flows. You are aligning with larger forces rather than trying to anticipate every movement. This reduces the emphasis on entry precision and increases the importance of context. This is a more sophisticated way of thinking. It moves you away from reactive trading and towards strategic positioning. Another critical aspect of execution is adaptability. Markets are constantly changing, and rigid adherence to a single entry style can become a limitation. However, adaptability must be structured, not reactive. Professional traders adapt their execution based on market conditions. In high volatility environments, they may widen their entry ranges and reduce position size. In low volatility environments, they may tighten their entries and adjust expectations for movement. This adaptability is not random. It is based on predefined rules and observations. The trader understands how different conditions affect execution and adjusts accordingly. Retail traders often attempt to adapt, but they do so emotionally. After a series of losses, they may change their entry criteria without a clear rationale. This leads to inconsistency and further losses. The key is to build adaptability into your framework. You should know in advance how your execution will change under different conditions. This allows you to remain consistent even as the market evolves. Entry, once again, is part of this system. It is not a fixed point, but a flexible component that adjusts within defined boundaries. This reduces the need for perfection and increases the robustness of your approach. Adaptability is what allows professionals to maintain performance across different regimes. It is not about finding the perfect entry in every condition. It is about adjusting your execution to remain aligned with the market. The relationship between execution and volatility is another area where traders often misunderstand the role of entry. Volatility determines how quickly and how far price moves, which directly impacts how trades should be executed. In high volatility environments, price moves rapidly and unpredictably. Attempting to achieve precise entries in these conditions is often counterproductive. The market can move significantly before your entry is triggered, or you may experience slippage that negates your precision. Professional traders recognize this and adjust their approach. They focus less on exact entry points and more on capturing the broader move. They may use wider entry zones and smaller position sizes to account for increased uncertainty. In low volatility environments, the opposite is true. Price moves more slowly and precision can be slightly more relevant. However, even in these conditions, the overall structure of the trade remains more important than the exact entry. Understanding volatility allows you to contextualize entry. It helps you determine how much precision is appropriate in a given environment. This prevents you from applying the same approach in all conditions. Execution is not static. It must respond to the characteristics of the market. Entry is one variable within this response, not the central focus. When you integrate volatility into your thinking, you develop a more nuanced approach to execution. You stop chasing precision in conditions where it is unrealistic, and you focus on aligning your strategy with the behavior of the market. Another layer to execution is the concept of opportunity cost. Every trade you take uses capital and attention. By focusing too heavily on perfect entries, traders often miss higher quality opportunities. This is a subtle but important point. If you spend excessive time waiting for the ideal entry on a marginal setup, you may overlook a stronger setup that offers better risk reward. This misallocation of attention reduces overall performance. Professional traders prioritize opportunities based on quality, not entry precision. They allocate capital to trades that align most strongly with their framework, even if the entry is not perfect. This requires a shift in mindset. You must evaluate trades based on their potential contribution to your overall portfolio, not on how precise the entry appears. This encourages better decision making and more efficient use of capital. Opportunity cost also reinforces the importance of selectivity. You do not need to trade frequently to be successful. You need to trade effectively. This means focusing on high quality setups and executing them consistently. Entry, in this context, becomes a secondary consideration. It is important, but it does not override the quality of the opportunity. This helps you avoid overtrading and improves your overall performance. Execution is about allocating resources efficiently. Entry is just one part of that allocation. The idea of missing a trade is another psychological trap linked to entry obsession. Traders often feel frustration when price moves without them, especially if they were waiting for a more precise entry. This leads to impulsive behavior. Professional traders do not think in terms of missing trades, they think in terms of missed processes. If a trade met their criteria and they failed to execute, that is a process error. If it did not meet their criteria, there is nothing to miss. This distinction is important. It removes the emotional component of missed opportunities. You are not chasing the market, you are following your framework. Entry obsession amplifies the fear of missing out. Traders wait for perfect entries, miss the move, and then enter late out of frustration. This leads to poor risk reward and inconsistent results. By accepting that you will not capture every move, you reduce this pressure. You focus on executing your edge, not on capturing every opportunity. This leads to more disciplined behavior. Execution becomes about participation within your framework, not about maximizing every possible gain. This is a more sustainable approach. Entry is simply the mechanism through which you participate. It is not the measure of your success. Another dimension of execution is the interaction between multiple time frames. Entry precision often comes from focusing on lower time frames, where price movements appear more granular. However, this can create a false sense of control. Professional traders use multiple time frames to inform their decisions, but they do not allow lower time frame noise to dominate their execution. They align their entries with higher time frame contexts, ensuring that their trades are supported by broader market structure. This approach reduces the importance of micro-level precision. If your trade is aligned with a higher time frame trend or macro view, small variations in entry become less significant. The larger move provides the opportunity. Retail traders often invert this process. They focus on lower time frames for entries without sufficient regard for higher time frame context. This leads to trades that lack structural support. Execution, therefore, must be anchored in the appropriate time frame. Entry is refined within that context, not isolated from it. This creates a more coherent approach. When you align time frames effectively, your entries become more meaningful. Even if they are not perfectly precise, they are part of a broader narrative rather than isolated decisions. This is how professionals maintain consistency. They integrate information across timeframes and execute within a structured framework. Technology and tools also influence how traders perceive entry. With advanced charting platforms and indicators, it is easy to believe that precision can be engineered through analysis. This creates an illusion of control. While tools can enhance your understanding, they do not eliminate uncertainty. Markets remain probabilistic, and no amount of analysis can guarantee a perfect entry. Relying too heavily on tools can lead to overconfidence. Professional traders use tools to support their framework, not to replace it. They understand the limitations of analysis and focus on decision making rather than prediction. This is an important distinction. Tools provide information, but execution requires judgment. Entry is the result of that judgment, not the output of a perfect formula. When you recognize this, you become less reliant on indicators for precision. You use them to inform your decisions, but you do not expect them to provide exact answers. This reduces the pressure on entry. You accept that uncertainty is inherent, and you design your process to accommodate it. This leads to more stable execution. Ultimately, execution is about aligning multiple variables into a coherent process. Entry is one of those variables, but it is not the most important. Risk, structure, management, and context all play a larger role in determining outcomes. When you integrate these elements effectively, entry becomes a natural consequence of your framework. You are not searching for perfection. You are executing a process. This is the hallmark of professional trading. Decisions are made within a structured system, not based on isolated variables. This creates consistency and resilience. The shift away from entry obsession is not about ignoring entry, it is about placing it in the correct context. It is a tool, not a solution. As you refine your execution, you will find that your focus naturally shifts. You spend less time analyzing entry points and more time thinking about structure, risk, and management. This is where real progress occurs. Execution is the bridge between strategy and performance. When that bridge is built correctly, the exact point at which you step onto it becomes far less important. At this stage, execution should be understood as a coordinated system rather than a sequence of isolated actions. Entry, sizing, timing, and management are not independent decisions. They are interconnected components that must function together. When one element is overemphasized, such as entry, the system becomes unbalanced. Professional traders design execution frameworks where each component reinforces the others. Entry aligns with risk placement. Position size reflects volatility. Trade management adapts to market behavior. None of these decisions are made in isolation. This integrated approach reduces the need for precision at any single point. You are not relying on one variable to carry the trade. Instead, you are distributing responsibility across multiple factors. This creates robustness. Retail traders often do the opposite. They concentrate risk into the entry. If the entry is wrong, the entire trade fails. This creates fragility. There is no margin for error and no flexibility in execution. By spreading decision making across the system, you create tolerance for imperfection. A slightly suboptimal entry can still lead to a successful trade if the other components are aligned. This is how professionals maintain consistency in uncertain environments. Execution, therefore, is about balance. It is about ensuring that no single element dominates the process. Entry is important, but it is only one part of a larger structure. A further refinement in execution comes from understanding conditional behavior. Markets do not move in a linear fashion. They respond to new information, shifts in sentiment, and changes in liquidity. Your execution must account for this. Professional traders define conditional responses before entering a trade. If the market moves in a certain way, they know how they will react. This could involve adding to a position, reducing exposure, or exiting entirely. This pre-planning reduces the importance of entry. You are not dependent on the initial decision being perfect because you have a framework for adapting as conditions change. This creates flexibility without sacrificing discipline. Retail traders often lack this structure. They enter a trade with a fixed idea and struggle to adapt when the market behaves differently. This leads to hesitation, emotional decision-making, and inconsistent outcomes. By incorporating conditional logic into your execution, you create a dynamic system. Entry becomes the starting point of a process that evolves over time. This aligns with the probabilistic nature of markets. Execution is not static, it is responsive. The ability to adapt within a structured framework is what separates professional traders from amateurs. Another dimension of execution is the role of conviction. Not all trades are equal, and your execution should reflect this. Higher conviction trades may justify larger position sizes or more aggressive entries, while lower conviction trades require more caution. This does not mean abandoning discipline. Conviction must be based on your framework, not on emotion. It should reflect the strength of alignment across your analysis, not your desire for a particular outcome. Professional traders allocate capital based on conviction. They do not treat every trade the same. This allows them to maximize returns when their edge is strongest while controlling risk when uncertainty is higher. Entry, in this context, is influenced by conviction but not defined by it. A high conviction trade may justify entering without waiting for perfect conditions, while a lower conviction trade may require more confirmation. This nuanced approach improves overall performance. You are not applying a one-size-fits-all execution model. You are adapting within a structured framework. Retail traders often struggle with this. They either overcommit to low-quality trades or undercommit to high-quality ones. This inconsistency reduces the effectiveness of their strategy. Execution must reflect the quality of the opportunity. Entry is adjusted accordingly, but it is never the sole determinant. The concept of scaling out is another critical aspect of execution that diminishes the importance of entry. Just as positions can be built over time, they can also be reduced gradually. Scaling out allows you to lock in profits while maintaining exposure to potential further gains. This reduces the pressure to exit at the perfect point. Instead of trying to time the exact top, you manage the position dynamically. Professional traders use scaling out to manage risk and optimize returns. They may take partial profit as the trade moves in their favor, reducing exposure while allowing the remaining position to run. This approach complements scaling in. Together, they create a flexible execution framework that adapts to market conditions. Entry becomes one part of a continuous process rather than a single decision. Retail traders often exit positions in a binary way. They either close the entire trade or hold it entirely. This lack of flexibility increases the importance of entry and exit precision, which is difficult to achieve consistently. By incorporating scaling, you reduce reliance on precision, you accept that you will not capture the exact top or bottom, and you design your process accordingly. Execution becomes about managing exposure over time, not about perfect timing at a single moment. Another important factor is the relationship between execution and feedback. Every trade provides information, but that information must be interpreted correctly. If you focus too heavily on entry, you risk drawing incorrect conclusions. For example, a losing trade may lead you to believe that your entry was poor, when in fact the trade was valid but the outcome was simply part of the distribution. Similarly, a winning trade may reinforce a flawed entry approach. Professional traders evaluate their execution based on process, not outcome. They ask whether the trade followed their framework, whether risk was managed correctly, and whether decisions were consistent. This process-oriented feedback loop allows for meaningful improvement. You refine your execution based on objective criteria rather than emotional reactions. Entry, therefore, is evaluated within the context of the entire trade. It is not judged in isolation. This prevents overfitting and maintains the integrity of your strategy. Retail traders often lack this discipline. They adjust their approach based on recent outcomes, leading to inconsistency and reduced performance. Execution must be reviewed systematically. This is how you build a robust process over time. The role of patience in execution cannot be overstated. Markets do not always present ideal conditions, and forcing trades leads to poor outcomes. Patience allows you to wait for alignment within your framework. However, patience is often misinterpreted as waiting for perfect entries. In reality, patience is about waiting for the right conditions, not the perfect price. Professional traders are selective. They do not feel the need to be constantly active. They understand that opportunities arise from specific conditions, and they wait for those conditions to materialize. This reduces the emphasis on entry precision. When you are selective, you can afford to accept slight imperfections in entry because the overall setup is strong. Retail traders often lack this patience. They feel compelled to trade frequently, leading to suboptimal decisions. This increases the pressure to find perfect entries, which rarely exist. By redefining patience, you improve your execution. You focus on quality over quantity. Entry becomes part of a broader decision, not the sole focus. Execution is also influenced by external factors such as news events and macroeconomic releases. These events can create sudden shifts in liquidity and volatility, impacting how trades should be executed. Professional traders account for these factors in their planning. They may avoid entering trades immediately before major announcements, or they may adjust position sizes to account for increased uncertainty. This awareness reduces reliance on entry precision. In highly uncertain environments, attempting to achieve exact entries is less important than managing risk appropriately. Retail traders often overlook this. They may enter trades without considering upcoming events, leading to unexpected volatility and poor execution. By incorporating external factors into your execution framework, you create a more resilient process. You are not caught off guard by sudden changes in market conditions. Entry is adjusted based on context, but it is never treated as a standalone variable. Another layer of execution is the concept of alignment across multiple trades. Professional traders do not view trades in isolation. They consider how each position interacts with others in their portfolio. This portfolio perspective influences execution decisions. For example, if multiple trades are exposed to the same risk factor, a trader may reduce position sizes or adjust entries to manage overall exposure. This reduces the importance of individual entry precision. The focus shifts to managing aggregate risk rather than optimizing each trade independently. Retail traders often ignore this. They treat each trade as a separate event without considering how it fits into their overall exposure. This can lead to unintended concentration of risk. By adopting a portfolio mindset, you improve your execution. You make decisions that enhance the stability of your overall performance. Entry becomes one component of a larger system. It is not optimized in isolation, but in relation to the entire portfolio. Discipline is the foundation of execution. Without it, even the best strategies fail. Discipline ensures that you follow your framework consistently, regardless of short-term outcomes. Entry obsession often undermines discipline. Traders deviate from their rules in search of better entries, leading to inconsistency. This erodes their edge over time. Professional traders maintain discipline by focusing on process. They trust their framework and execute it consistently. They do not chase perfection, and they do not react emotionally to market movements. This disciplined approach creates stability. Over time, consistent execution leads to predictable outcomes. This is the goal of professional trading. Entry within this context is simply one of many rules to follow. It is not an opportunity to improvise. It is part of a structured system. By reinforcing discipline, you strengthen your execution. You reduce variability and improve performance. The final integration of this lecture is understanding that execution is a skill developed over time. It is not something that can be perfected instantly. It requires practice, reflection, and continuous refinement. Entry will always be part of execution, but it should never dominate your thinking. The most successful traders are those who build robust processes that perform across a wide range of conditions. When you shift your focus from precision to process, you unlock a higher level of performance. You become less reactive, more consistent, and better equipped to handle uncertainty. Execution is where strategy meets reality. It is where decisions are tested in the market. By approaching it with structure and discipline, you create a foundation for long-term success. The key takeaway is simple but powerful. Entry matters, but it matters far less than you think. What truly drives performance is how you structure, manage, and execute your trades over time. This is the mindset of a professional trader.